You see it everywhere from trading floors to smartphones, but what is it? Let me take you on a journey through the science, the systems, and the surprising places where Monte Carlo simulation is changing our world. Welcome to this channel. Sit back and watch as we dive deep into the most important concepts shaping today's technological world. And if you enjoy it, subscribe for more great content. It all began during the 1940s at the height of the Manhattan Project. Scientists were trying to calculate the probability of successful outcomes for nuclear chain reactions. But the math was impossibly complex. Enter Nicholas Metropolis and his team. They hit upon an idea, repeatedly sample randomly, and then extrapolate a result. Boom! The birth of Monte Carlo, now named after the famous casino in Monaco. But why Monte Carlo? Why not just solve the math problem directly? Well, when dealing with complex systems and problems involving inherent randomness, like nuclear reactions, weather patterns, or market fluctuations, deriving a precise analytical solution is often impossible or extremely difficult. This is where Monte Carlo steps in. Instead of grappling with complicated formulas, Monte Carlo employs an army of random numbers to do the heavy lifting. By simulating numerous scenarios and analyzing their outcomes, we can estimate probabilities and make informed decisions even in situations where the underlying mechanics are governed by pure chance. At its core, Monte Carlo relies on two fundamental pillars. First, pseudo-random number generators. These are algorithms that produce a sequence of numbers that mimic randomness, but they're not truly random. They are generated by deterministic algorithms called PRNGs, which, given a starting value called a seed, can generate sequences of numbers that appear random. The most common PRNG is the Mersenne twister. Secondly, probability distributions. Every outcome in a given scenario follows a particular distribution based on its likelihood. For instance, if we flip a coin, each possibility has a probability of 0.5. In essence, Monte Carlo leverages these tools to model reality. By simulating many possible futures and quantifying their likelihood, we gain insights into the dynamics of complex systems, from the tiniest subatomic particles to the vast expanse of global economies. Now, let's talk about how this works in practice. Let's start with the most basic element of finance, the option contract. An option gives you the right, but not the obligation, to buy or sell an asset at a specific price before a specific date. To determine the fair price of an option, we need to consider various factors such as the underlying asset's current price, strike price, time until expiration, and volatility. The Black-Scholes equation is the standard method for pricing options. However, there's a snag. It uses a complex formula that assumes certain conditions, like a risk-free interest rate and no dividends, which aren't always met in real life. That's where Monte Carlo comes to the rescue. We simulate the future price path of the underlying asset and determine the option's payoff in each scenario. Then we discount those payoffs back to the present day using risk-free interest rates, and voila! We have a Monte Carlo price for the option. Next up, we have the binomial model. Imagine breaking down the asset's price path into a series of up and down steps, where the probability of going up or down is determined by historical data or other relevant factors. At each step, we calculate the option's payoff and work backward to find its value at the beginning of the period. By repeating this process for each time step, we arrive at a series of option values that help us make informed trading decisions. But Monte Carlo's applications go beyond just pricing. Risk metrics such as value at risk, or VA, are essential for understanding the potential losses a portfolio might face within a specific confidence level and time frame. Imagine you have $1 million invested in stocks, and you want to know the maximum amount you could lose with a 95% certainty over the next month. Well, instead of relying on historical data and its limitations, Monte Carlo allows us to simulate thousands of potential market scenarios over that month. By analyzing these simulations, we can pinpoint the worst-case scenario that would result in a loss of approximately $100,000, giving us a comprehensive view of our portfolio's risk profile. Another vital tool in risk management is the conditional value at risk, also known as CVAR or expected shortfall. While VAR provides a snapshot of the potential worst-case scenario, CVAR delves deeper by estimating the average loss given that a portfolio's losses exceed the VAR threshold. It offers a more nuanced perspective on risk, considering not just the likelihood of extreme events, but also their potential severity. Using Monte Carlo simulations, we can explore various market conditions and calculate the expected shortfall, allowing us to make more informed investment choices and navigate financial uncertainties with greater confidence. The application of Monte Carlo simulation extends far beyond individual assets or static portfolios. Asset allocation strategies aim to divide investments across different asset classes to optimize returns while managing risks. A well-known approach is the efficient frontier, which plots expected return against risk, enabling investors to choose a portfolio that aligns with their risk appetite. Using Monte Carlo simulations, we can dynamically generate thousands of potential investment scenarios, allowing us to accurately plot the efficient frontier and select the optimal asset allocation strategy for our financial goals. Let's dive into a real-world example. Remember the 2020 oil crash, where oil futures briefly went negative for the first time in history? This unprecedented event left many market participants scrambling. But imagine if you had the foresight to simulate such a scenario beforehand. With Monte Carlo simulation, we can model the storage costs, demand, and supply dynamics to understand the likelihood of oil prices dropping below zero. By analyzing these simulations, you could have assessed the associated risks and made informed investment decisions to safeguard your portfolio against such extreme events. Another fascinating case involves Tesla's options trading surge in 2021. During this period, the price of Tesla stock exhibited unusual volatility, leading to a spike in options trading activity. Monte Carlo simulations could have been instrumental in pricing exotic options on Tesla stock. Exotic options are options with complex payoff structures that don't fit the standard models. By simulating the potential price path of Tesla stock and incorporating factors like implied volatility, these simulations could have helped traders price these complex options more accurately, navigating the volatile market conditions. Looking ahead, Monte Carlo simulation is poised to play an increasingly significant role in various sectors. In the world of exchange-traded funds and notes, understanding the underlying index behavior is crucial. Whether it's an ETF like SPY, an S&P 500 tracking fund, or an ETN like the Barclays Bank linked to the FTSE 100 index, Monte Carlo can help predict future index levels and volatility projections. For leverage ETFs like TBT, which aim to deliver triple the inverse daily return of the S&P 500, simulations are invaluable in assessing potential risks and returns. But it doesn't stop there. Monte Carlo simulation is also employed in commodity pricing. Consider gold futures, lithium prices for electric vehicle batteries, or agricultural commodities like coffee. By analyzing market trends, historical data, and other relevant factors, these simulations can provide insights into the future price movements of these commodities, assisting investors and businesses in making informed trading and hedging decisions. Take, for instance, the ARK Innovation ETF under the management of Cathie Wood. This fund focuses on high-volatility tech stocks like Tesla, Genomic, and Teladoc. Given the high volatility of these investments, understanding potential price fluctuations is crucial. Monte Carlo simulation can help predict future stock prices by incorporating historical volatility, news sentiment, and other relevant factors, aiding investors in assessing the risks and potential returns of this ETF. As for cryptocurrencies, volatility is a defining feature. Imagine simulating Bitcoin's stochastic paths to better understand its price action and assess potential risks. Ethereum's gas price forecasting also benefits from Monte Carlo options on crypto like Deribit Exchange, which offers options on Bitcoin, Ethereum, and other cryptocurrencies can leverage simulations to model potential price scenarios and refine their trading strategies. Even crypto arbitrage, the practice of exploiting price differences across markets, can be enhanced with Monte Carlo simulations, allowing traders to navigate the dynamic cryptocurrency landscape with greater confidence. One notable case study is the Anchor protocol in the Terra Luna crash of 2022. Anchor Protocol, a prominent borrowing and lending platform, the Terra ecosystem promised a remarkable 20% annual return on its stablecoin UST. However, this seemingly lucrative offer proved unsustainable, contributing to the eventual depegging of UST and the collapse of the Terra network. In hindsight, simulations could have been employed to stress test the protocol's long-term viability, possibly flagging potential risks before the crisis unfolded. Looking forward, Monte Carlo will continue to revolutionize our approach to risk analysis and decision-making in the dynamic world of finance. Its applications extend far beyond traditional markets, influencing industries like supply chain management, healthcare, and even the realm of quantum computing. In global supply chains, managing complexities and uncertainties is paramount. From port congestion to transportation delays, disruptions can significantly impact delivery times and costs. Monte Carlo simulation can help model these uncertainties by simulating the movement of containers through various stages of the supply chain. By analyzing numerous scenarios, businesses can develop robust plans to mitigate risks and optimize efficiency. Moreover, geopolitical tensions add another layer of complexity to global trade. Events like the Red Sea blockage in 2021 or the Suez Canal blockage in 2020 to highlight the fragility of global supply chains. Simulations can incorporate geopolitical risks, helping companies assess potential disruptions and develop contingency plans to ensure business continuity. Furthermore, blockchain integration adds a new dimension to supply chain management. Smart contract simulations can track product provenance and ensure authenticity. By simulating the movement of goods along the supply chain, businesses can verify the integrity of their products and build consumer trust. Additionally, tokenizing supply chain finance, as exemplified by Tradolens, a joint venture between IBM and Maersk, allows for the representation of trade documents as digital tokens on a blockchain. Monte Carlo simulations can assess the efficiency and risks associated with these tokenized systems, providing valuable insights for optimizing supply chain finance. Let's turn our attention to non-governmental organizations, or NGOs. These organizations play a vital role in addressing global challenges and improving lives worldwide. When it comes to large-scale initiatives, making informed decisions is crucial. Take disease outbreaks like Ebola and COVID-19. NGOs and health organizations like the Red Cross and the World Health Organization, who utilize Monte Carlo models to simulate the spread of diseases under various intervention scenarios. By simulating the impact of vaccination campaigns, quarantine measures, or resource allocation strategies, these organizations can optimize their response efforts and allocate resources effectively to contain outbreaks. Moreover, in disaster relief and humanitarian aid, NGOs often face the challenge of efficiently distributing resources in crisis situations. Monte Carlo simulations can help model the evolving needs of affected populations, simulate the effectiveness of different aid distribution strategies, and assist in making timely and informed decisions to maximize the impact of relief efforts. When it comes to environmental conservation and sustainability, NGOs and governments are increasingly turning to Monte Carlo simulation to tackle pressing issues. Climate change poses a significant threat, and understanding its potential impacts is vital. Simulations can model the effects of rising temperatures, sea levels, and extreme weather events, allowing organizations to assess vulnerabilities and develop mitigation strategies. Furthermore, NGOs working on reforestation or habitat restoration projects can use Monte Carlo to evaluate the success rates of different intervention strategies. By simulating the growth and survival of trees under various conditions, these organizations can optimize planting techniques and resource allocation to maximize the impact of their conservation efforts. Lastly, as we look to the future of Monte Carlo simulation, we can expect exciting advancements driven by emerging technologies and interdisciplinary collaborations. One notable area is the integration of Monte Carlo with artificial intelligence or AI. By combining the power of AI and Monte Carlo methods, we can enhance the efficiency and accuracy of simulations in various domains. AI algorithms can learn from historical data, identify patterns, and make predictions that can be incorporated into Monte Carlo models to improve their performance. Additionally, quantum computing holds immense potential for accelerating Monte Carlo simulations. Quantum algorithms can execute complex calculations significantly faster than classical computers, enabling us to tackle larger and more intricate problems. As quantum computing technology advances, we can expect Monte Carlo simulations to benefit from increased speed and efficiency, leading to more accurate and insightful results. In conclusion, Monte Carlo simulation is a powerful tool that has revolutionized our approach to managing risk and making strategic decisions. From finance to supply chain management, healthcare, and environmental conservation, its applications are vast and continue to expand. As technology advances and interdisciplinary collaborations flourish, we can expect even more innovative uses of Monte Carlo simulation in shaping a better future. So embrace the power of randomness in your decision-making and unlock new possibilities in your field. Thanks for watching.